let's talk about fiscal and monetary policy. Alright, so these are two economic tools that government use to regulate the economy. Alright, so these are two important tools, right, which can help us help the government regulate the economy. Right, first is fiscal policy. Right, so they can be expansionary as well. Right, so basically they are based on three different pillars such as expenditure, income, and then borrowing. Okay, so how do they influence it? So they basically have to balance all these three things. Okay, so they basically have to balance. So income basically they get from where? The income is from tax. Okay, and then if the expenditure is higher than the income from taxes, they have to borrow. Right, borrow. So if of course that's basically how they do it. Right, so if income is greater than expenditure, they borrow. Okay, so the financial crisis has shown that many governments had created high borrowings, right, to reduce these. Particularly in Europe, austerity measures have been introduced and government were forced to reduce their expenditure. Right, so when they do high borrowing, what has happened? When they do high borrowing, what happens is that basically they have to pay interest in that, and then if your income is not sustainable, if it's not sustainable, if you borrow too much, of course you'll have default as well. Right, of course you will have your country's debt, your credit rating will be impacted as well. Right, so normally in Western countries the government expenditure is about 40-50%. Right, so of all expenditures. So government expenditure it consists how much? 50% of overall expenditure. So that's a huge chunk for a business. Right, so basically because of course different government organization will be buying from you as well. Right, so government policies and spending have a powerful effect on an organization. Right, basically if they reduce the expenditure, of course your income is going to be reduced as a business. Okay, as a business. And then next tool is monetary policy. Right, so in terms of monetary policy, they try to control the economic. Right, so they try to the approach is to economic control, attempts to manage the supply of money. So they want to basically manage the supply of money, which can be done through different measures. Okay, so the supply of money will be dependent based on interest rates. Right, next thing is basically the money supply, the physical printing of money. Right, the printing of money. Next thing is reserve requirements. Right, so what proportion of money deposited by customers may bank lend? So this could be like different percentage based on how they want to control the money supply. Okay, and credit controls. So example, if a person is buying item on credit, what is the minimum deposit they must give? Right, so that could be implemented. So these are the techniques through which they can control the money supply. This will have an effect on the business. How? Basically if the interest rate are high and you are a mortgage seller, of course your basically your people would be less reluctant to buy a mortgage at that time. Right, when the interest rate are high. Right, so that would have an impact. Right, so these two tools help what? Government to stimulate economy during a recession. Right, so they use both these tools in combination. Okay, so they complement each other, not like they have expansionary policy and then they raise rates. Right, so it's going to be something, they work in tandem with each other. Okay, so that's how they basically use these two tools to regulate the economy or to stimulate it. That's it for this video. Take care. Bye bye.